Thank you guys for everybody who's watching this video. My name is Nikhil Javeri. I'm the Chief Investment Officer for ECMG. Today we're going to just kind of walk through, what makes a good stock pitch. I want to give you guys a framework for how to think about this, especially because for a lot of you guys, this will be your first stock pitch. And there's nothing wrong with that. I don't think I created a stock pitch until actually later on in my freshman year than you guys were doing it because I didn't join ECMG until second semester. So, wanted to provide this video tutorial just as something for you guys to sort of use as a frame of reference, if it's something that you're not familiar with. And if it is, I still think some of the things that I'll mention in this video will be helpful. So definitely make sure to walk through it if you have a chance. I guess touching on why it's useful a little bit, and I talked about it at the call-out meeting, but when you're doing equity research, there's two functions. So the sell side is essentially the people that are publishing all of these reports. You have analysts that essentially know the industries inside and out, and they have teams that basically gather data, continue to publish reports on each of the companies in their coverage. That's the sell side, and that's actually where a lot of people will start off in finance if they're doing equity research, or honestly for most careers. And then there's the buy side, and the buy side are the people that actually are investing money in companies, taking like long-term, short-term views, depending on whether you're a long only or a hedge fund. So it kind of depends on, what type of buy side firm you are as well. But at ECMG, we kind of fulfill both functions in that we're doing the equity research. You guys, the analysts, are doing the equity research. When you come in, you guys are doing those stock pitch presentations. And then essentially we are also investors. We hold capital that we invest. And so we kind of fulfill both of those functions, because it's a really great way for you guys to sort of understand how the world of finance works. So that's kind of why it's useful. This pitch on the right here is a pitch that I did, I think April of 2022, if I'm not mistaken. I will be sending this out accompanying this video. So if it's something that would help you guys take a look at it, I think it might be a little bit helpful just to kind of think about, where to think. So how do you start with the stock pitch? I mean, I kind of walked through this in the call out, but we're gonna have macro research functions in ECMG. For the purposes of this one, focus on these resources on the right. So Mergent Online, I walked through a little bit how to use it, but it's essentially a very good tool for actually looking at sell side research. You can go there, you can access it through IU libraries, and then go to the invest text function, and just type in any company that you're interested in learning more about, contributor, whatever, and it'll pull up a bunch of sell side research reports. So definitely be sure to look at that. It's a great way to learn. Barron's, Wall Street Journal, Financial Times, all these other financial publications are also very useful. And I think that's something that you should definitely read in preparation for just the interview as well, because it's good to know and how to kind of have a sense of like what's happening in the marketplace and, what's driving stocks, what's driving bonds, are they driving each other? Who knows? So try to get a sense of kind of what's happening. Obviously, it's going to be hard to kind of get all of that done in a week, and we're not expecting that from you guys. I want to make that very clear because a lot of people don't come into college. I didn't come into college with any of this sort of experience in like understanding some of this stuff. So obviously just, give it your best shot with some of this stuff, and we'll kind of get a gauge for where you're at in the interview. The more important thing is that you're teachable, you're willing to learn, and you can work in a team. That's the main things that we're looking for. So yeah, with that, when you're looking at a stock, you want to start with an industry, and you can't not start with an industry, quite frankly, because I can't understand Microsoft's business model without understanding what they're doing to address the threat of Google, Amazon, Apple, all these other companies in their space. Ultimately, that's how companies operate, is they're reacting to their competitors. And so we're going to look at, a framework called Porter's 5 Forces. And it essentially helps you find where competitive disadvantages or advantages might be overall, kind of how things like pricing power, intellectual property can either drive or hinder the business. And this is a really good framework for kind of thinking about industries on a very high level. Obviously, each industry is going to have different, degrees of rivalry, threats of new entrants. So you kind of need to have an understanding for that on your industry basis, but this is kind of how you should think about it. So the first of these is degree of rivalry. And this is essentially just asking how many competitors are there in the industry and what does their size look like relative to each other. So, for example, industries with high degrees of rivalry typically have similar players competing for virtually the same market share. So one example of this would be the aircraft manufacturer industry, where essentially Boeing and Airbus are competing with each other when airlines pretty much outside the Europe and United States are planning to update their fleet. And so, like Air India just bought a bunch of Boeings, and that's like a huge contract for them because they're always fighting with Airbus for those contracts. And so that's somewhere where, you would see a high degree of rivalry as a result of a low number of players in the industry. Hope that kind of makes sense. Second of Porter's five forces is going to be the threat of new entrants. And I think this is way easier to just kind of think of in terms of like barriers to entry. So like, and there's different barriers to entry. In some cases, it'll be high fixed costs, and that's kind of the one that we're all familiar with. So like telecom, for example, you need a lot of capital to get a telecom business going because you got to invest in infrastructure, you got to invest in cable lines. All that stuff takes a very high amount of fixed costs, and that's why you really see a lot of consolidation there with really the four major carriers, or three now that T-Mobile actually bought Sprint. But in others, it could be like an intellectual property barrier. So for example, in a pharmaceutical company, they may have to like recreate some drug that another company has made without copying the actual chemistry that's referenced in the patent. And so that's kind of how you should think about, threat of new entrants on an industry level. It could be very different for healthcare, telecom, retail, whatever that might be. I think brand power is something that kind of plays into that too. So like, let's think about retail. If a grocery store is hoping to kind of replicate that Costco model of just having a ton of products kind of selling in bulk, they're going to face a lot of challenges because you need to first achieve the same mind share that Costco has, in terms of the consumer, Costco, Walmart, Target, Kroger, all of those guys. And then you really need to kind of be able to also get their same suppliers. Like you need to be able to secure the supply to sell that much bulk. We'll kind of talk about that a little bit more with brand bargaining power of suppliers, but that's kind of something you should also think about in terms of threat of new entrants. Is brand power really resonating, factor in that industry? I guess maybe one more example here, like industries with high threat of new entrants might be something like restaurants, where opening a small business on the corner of like a small town can very easily compete with like a local Chipotle. So even though the franchising model may be harder to replicate on a small business basis, the threat of new entrants is certainly there. So hopefully that kind of helps you think about barriers to entry. The third of Porter's five forces is a bargaining power of suppliers, and we kind of talked about this earlier, but Walmart is a company that's notorious for negotiating extremely favorable supplier contracts for themselves because suppliers realize the value of having their products in a store that is, Walmart's going to attract millions of customers monthly. And so in this sense, brand power is also a driver of lower bargaining power because you essentially have like, if you have the brand power that Walmart has, your suppliers can't really say, oh no, I'm going to go to somebody else, because Walmart would just find another supplier essentially that's going to give them the same amount of supply at probably a more attractive price. And so Walmart's a company that's been notoriously good for that. Conversely, higher bargaining power is something that could be driven by like high switching costs. So that's something that could deter kind of changing from the existing supplier structure if you have to completely either change over like the system, whatever it may be that causes a hindrance in you switching over from one supplier to another. That's something that could affect bargaining power of suppliers as well. And then, yeah, so that's kind of, I would say that's how you can think about bargaining power of suppliers. The fourth of these forces, bargaining power of buyers. I think, what's a good example of this? The hotel industry. So all of you guys, I hope all of you guys have traveled. You're going to stay in like one of like a Marriott, Hilton, Hyatt, but then you could also have an alternative option like Airbnb, or even just like staying with family. And so there's a lot of substitutes in like the hotel industry, and that's essentially a point of leverage for driving bargaining power of buyers, because the end user really has a ton of options that they can actually choose from. So that's kind of what you're thinking about with bargaining power of suppliers. What is your business's end user, and what is the optionality they have in terms of like availability of, I don't want to say availability of substitutes because that's something else, but like how many can they get the similar product offering somewhere else, is kind of how you should think about it. So like if I have 5 other options where I can stay, the bargaining power that I have over a firm like Marriott is pretty high. And that's also why in the hotel industry, you see these like really kind of fruitful loyalty programs as an alternative incentive, because once they lock you into those programs, you get those points. It's very easy to kind of keep redeeming them. And they don't lose that business out to one of their competitors, or even just like staying with your family. So that's how you should think about bargaining power of buyers in terms of high bargaining powers of buyers. I think on the opposite end of the spectrum, you have low options for buyers in things like healthcare, where the law will essentially allow drug manufacturers to charge whatever they'd like for certain drugs, which actually may not be the case going forward, but right now that's kind of how it is. So in this case, if you need the medication, right, like there's not really a whole lot of bargaining power between you and a pharmacy to say like, hey, like I can go get this somewhere else, because you can't, or you can, but it'll cost you the same price no matter where you go. And so there's not really a price aspect there where people are kind of able to like penetrate price, which is kind of something that's, you know, very unique to the American pharmaceutical and healthcare system. But that's kind of how you should think about low bargaining power of buyers. And also that kind of plays into like intellectual property barriers as well, where the drug is essentially something that's proprietary to the drug manufacturer. And so anybody developing the same drug, or you can't develop the same drug, you have to do something kind of different. And so intellectual property certainly has a place within that force as well. And then the last of these is availability of substitutes. So it's kind of like availability of substitutes is sort of like kind of it doesn't really fit in with some of these other ones, and it fits in with kind of like each of these, because when you think about bargaining power of suppliers, you're also thinking about how much like availability of substitute of suppliers there are. But we give it its own one because it kind of does warrant separation. And so you really want to ask yourself, how many viable alternatives exist across this industry? And, you know, if your switching costs are high, what features, again, is that end market looking for? And might that disqualify, you know, one product as a substitute for another? And so when you think about something like pricing power, which obviously every company wants to have good pricing power, that starts to erode when the availability of substitutes in an industry is high, especially in availability of like cheap alternatives. So substitutes can definitely, you know, that's kind of where you want to think about price the most, because a lot of times competitors to one's business are either going to be trying to price them out of the market by, you know, just having very low prices, or they may have higher prices. And then that's an opportunity for your business to, I guess, capture more demand as a result of like maybe a weakening consumer that you see in macro. So those are kind of how you should think about, I guess, maybe a higher low availability of substitutes. I think what's a good example here? Let's think about EVs. The low cost. So for those of you guys that don't know, in the EV space, there's a Chinese company called BYD. And basically this company can manufacture a electric vehicle for half the cost that most of these American manufacturers are able to get it at. In part due to natural resources, in part due to labor. There's a couple kind of factors in there, but really they're able to sell you a new electric vehicle probably around like 16,000 to 20,000. If not now, within a few years is kind of their goal for that. So when you think about a company like Tesla, where, you know, those prices, they're coming down, but they're still, you know, entry level is probably about 28, 29,000. That's somewhere where BYD has a competitive advantage in terms of having a cheap alternative. And so that's also why you see a very high level of EV adoption in China, because that company has just done so well to kind of price out all the other competitors, and BYD really owns that market. So I think analyzing industries through, you know, availability of substitutes, that lens will definitely kind of help you understand too, like, how does XYZ company form a competitive moat through the offering of their products and services that are simply kind of hard to create, replicate, or like create substitutes for. That's kind of how to think about availability of substitutes. Great. Spent a lot of time on industry analysis, and I did that purposefully because it's very important. You're not going to understand these companies unless you understand their industries. And again, I'm not saying read the 10Ks of every single competitor of like Costco, like Walmart, Target, Kroger, Albertsons, BJ. Like, you don't need to do that. But you need to understand their business model and fundamentally, like, how are they different? What is each company's strategy to take market share? That's really what you want to think about. And usually it'll kind of come back to one of these forces. So, yeah, industry analysis. I mean, I would definitely recommend you spend a good bit of time to understand the industry, because in the interview, you'll probably get some questions on that as well as the company that you're actually pitching. Great. Okay. Now that we've looked at a lens for understanding industries, how should you approach the actual stock pitch? I think one way to do it is like think of it like an argumentative essay. So, you have your thesis that's going to present kind of this multi-pronged investment idea that you believe the market is missing out on. And so your catalyst might be based on three drivers: revenue, market share, and margin. And the key aspect before I kind of go into those three is you need to understand what is and isn't priced into the stock, which is very difficult to do, by the way. I probably did not understand that concept until late in my freshman year, if not early in my sophomore year. So like that is something that takes time. And I don't want you guys to think that you need to understand all of this stuff right away, because ultimately the goal of ECMG again is to kind of teach you some of this stuff. But things mentioned on earnings calls or like new product releases, those are immediately priced into the stock through investor reaction. So investors, when they hear this news, they will either invest a lot of money in it and push the stock price up, or they will, withdraw their money because they don't like the idea and it'll push the stock price down. And that happens almost instantaneously. And that obviously is part of kind of these, not obviously, but like that's part of what's called the efficient market hypothesis, which if any of you guys have some extra time, feel free to look into it. It's a really interesting theory. But kind of coming back to this part, so like if the CEO mentions something on an earnings call, that isn't really something that you can say is like a pure catalyst. Now, what you can do is give yourself a different interpretation of what that CEO said than what the market typically, or what the market interpreted. So you're essentially saying they did this company did this. This is how the market saw it. This is how I see it. And I see it a little bit differently than the market. And that's what's going to push it forward. So let's walk through an example of that. If anybody follows kind of like the sports betting industry, Penn Entertainment actually partnered with Disney's ESPN brand earlier this month to form ESPN Bet. ESPN Bet's just, it's going to be Penn's gaming platform, but they get to use ESPN's name. I'm sure there's some sort of licensing agreements where ESPN can kind of like advertise that on their channel, whatever that may be. The market actually punished Penn for this. They assumed that the resulting market share gains for Penn Entertainment from this partnership would not justify the $2 billion or so cost that Penn actually had to bear to use ESPN's name in their product. And so the stock fell on it. Now, that's what kind of all of Wall Street thinks. Your goal as an analyst, as hard as it sounds, is to say no. Like I think the widespread consensus of investors is actually wrong. And a lot of people do that, but like, that's the job of an equity research analyst. So one potential catalyst with this sort of scenario would be, okay, the ESPN name is going to allow them to take a greater market share in the online sports betting market from incumbents like DraftKings and FanDuel. And that's kind of that's your thesis right there, because you sort of have like this total addressable market of, the industry. And you're saying maybe instead of taking 8% market share, like the market's assuming, they're going to get 12% market share. And a lot of actually valuing what that change means comes down to like valuation, which we don't need you guys to do. We don't want you guys to do for the purposes of this pitch. But that's kind of how you think about it. So, and that would be one example of a market share catalyst. So like I mentioned, there's three types of catalysts: revenue, margin, market share. This would be a market share catalyst because you're essentially saying that having that ESPN name is going to allow you to take more market share than the street is assuming. And taking more market share as a percentage of like that total market will honestly increase your revenue. But what it also does is it warrants what we call multiple expansion. I'll kind of touch on it briefly. There's two types of catalysts. There's an earnings catalyst and a multiple catalyst. Earnings catalyst is kind of what you see on the slide here with revenue and margins. They're directly traceable to the income statement. So you're either reducing your expenses or you're growing your revenue. It's one of those two. Market share catalysts might warrant multiple expansion, which is essentially saying that right now the stock trades at a 12 times PE multiple, price to earnings. And so you're paying $12 for every $1 of earnings of that company's stock. In 1 year, 2 years, whatever the time horizon may be, you're going to want to pay $18, $19 for every $1 of earnings of that company's stock, because the growth profile will be that much more stronger as a result of, in Penn's case, this partnership. And so that's kind of how you think about multiple expansion. The market trades at about 18, 19 times. And so that's what you would kind of use as a framework for whether the industry also kind of trades at a below market multiple or an above market multiple. Little bit complex there. Again, I'm also, I would encourage you guys, if you guys have any questions on kind of what I'm walking through here, definitely email me. Be happy to kind of, walk through some of this stuff further. But that's kind of a market share catalyst. And so let's see. Yeah, I think that pretty much covers it. Market share catalyst, Penn's going to take more market share from the incumbents in the space. That's one. The second type of catalyst is a revenue catalyst. And when you're looking at revenue is what? It's simply price times volume. But you, of course, kind of have to analyze the nuance of what happens to volume when price goes up. And so that's elasticity, right? And if you believe that the market is failing to reflect an inelasticity to demand of a company's product and good, and that will, in fact, the consumers will pay a higher price for that good, then you have a revenue catalyst. And so in layman's terms, can company XYZ take price without losing demand for their product and service? And if so, is that reflected in the stock price? And so we'll stick with an example of Disney here. They recently chose to raise prices on their Disney Plus streaming offering from $9.99 to, I want to say $12.99, but they raised prices. That's obviously a revenue driver if, they're taking price and they're not losing any volume. And so the stock actually rose 5% off that news. Maybe looking at it the other way, on a short pitch side, one catalyst for a short pitch, or maybe saying that Disney's going to fall further from here, is that you believe that these price raises will cause more people to turn away from Disney Plus than maybe the street believes. Of course, you kind of need a qualitative reason for that. Basically, that would be like, okay, Warner Brothers, Netflix, Peacock, all of these streaming platforms actually are creating better content than Disney. And so the demand's not going to be there, and raising price is only going to kill demand even more. That could be, that could be a catalyst for like a short investment thesis. For this purpose, I would say kind of go stick with longs, but that's kind of how you should think about it. And I think you kind of need to kind of keep asking yourself why with some of these things. So like, okay, if Disney has worse content, why do they have worse content? Well, maybe they have worse content because they started releasing these exclusive movies on Disney Plus during the pandemic, and it took away from the exclusivity of the product. Whatever that may be, kind of keep digging down that rabbit hole to figure out why. And I think that's a really helpful exercise. If you keep kind of just asking yourself why, you'll also learn a tremendous amount about like the actual business itself. Okay, great. And in this case, you're kind of predicting a lower top line or lower revenue than the widespread consensus, which, if you think about the income statement, which you guys will learn sort of in accounting, we'll teach you guys some of that stuff too, kind of just flows down into a lower free cash flow per share, all else equal. And so that's kind of the one sort of figure that you want to think about, because ultimately shareholders, all they care about is whether or not they're getting paid cash in terms of like how much they're owning per share. Again, for the purposes of this pitch, don't have to model free cash flow out or anything for that matter. And we'd strongly recommend you stick with long pitches, but this is just an example of how you might look into a negative revenue catalyst. And then finally, you have margin catalyst, which can be a little bit more complicated. In equity research, we pay attention to the income statement because net income tells you how much money a company can return to its shareholders. And so in this sense, cost cutting can actually elevate the bottom line of a company to provide them with more capital to return. And the key question here is whether the costs that are being cut are key to the operations of the business. So, for example, when Meta cut their labor force last year, I think it was like 8,000 jobs, the stock killed it because everybody, not even Wall Street, everybody around the world knew that tech had overhired during the pandemic in response to very high demand. And so investors knew that Meta would continue to function with 8,000 less jobs. And so the cuts were purely a boost to earnings. And so that's kind of how you think about a positive margin catalyst. with the idea of things being priced in, that would have been priced into the stock right away. And so you're kind of looking again for inconsistencies in how the market interprets it. So maybe you're saying like Meta's going to do more job cuts, and I don't think the market is currently reflecting that. That would obviously have to be backed up with a fundamental understanding of the business and why they can operate with a lower margin, or sorry, lower workforce than they have now. But that's kind of how you should think about it. Also, a nuance here is that short-term margin dilution isn't always negative, and short-term margin accretion isn't always positive. So one example of this is Carnival Cruises. Within the cruise industry, there are three main players: Royal Caribbean, Carnival, and Norwegian. And they all operate somewhat differently, but the widespread consensus for a while has been that Carnival continues to underspend on marketing to bring in customers. And so August 7th, you guys can look at this chart, the stock was up 5%. Why? Because a research publisher in the cruise industry had actually published that Carnival's ad spend was up, I think, about like 150% in 2022. But the market reacted, sorry, one sec. Okay. The market reacted, pushing the stock up 5%, even though Carnival had made a move that's going to actually cost them in the short term, chipping away at the bottom line. So they're going to attract more customers long term as a result of spending more on marketing, even though that's going to kill their margin in the short term. Investors realize that the demand that they're bringing in from that marketing spend is actually going to outweigh the cost that they're doing right now, hence why the stock went up. And so again, understanding these nuances can really only come with a detailed understanding of the industry's dynamics, which we are not expecting you guys to like be an expert on any industry by any means. I covered gaming, leisure, and lodging last summer, hence why I went with the Penn and Carnival examples. But I, after 10 weeks, didn't even really fully understand some of these companies. So it will take a while for you to kind of get some of these industry dynamics. But that's kind of why we recommend you look into industries beforehand. Okay, chugging along, let's look at the risks. Big thing here is just don't pick something too big picture. So for example, if you're going to do something like another pandemic or like a global war between China and the US, that's going to be a risk to pretty much every industry out there. And so it's not specific to your industry, and you want it to be kind of something that's either firm specific or industry specific. So one example in retail right now, if any of you guys have been following, Target, Dick's Sporting Goods, any of these companies, is what they're calling inventory shrink, but it's basically just theft. People have less money, and so they're starting to steal from some of these stores, and it's really kind of causing them to take huge markdowns in terms of like how much inventory they're losing, and they're not bringing in revenue for it. And so that'd be a justifiable risk if you're pitching a retailer, because they're all facing it. And even if you want to kind of take it one step further, there are certain companies whose inventory management systems are far worse than others. And so you could think about it from that lens, where this is already an issue that's plaguing the industry, and on a firm level, this is why the firm is even more likely to suffer from that. These are all just examples, but I think generally the risk should be something that could either invalidate or trump the catalyst that you've presented in investors' minds. Last thing to remember is that you're an analyst, not a salesman. So this is kind of where I'll stray from like the 3-paragraph one, kind of counterpoint sort of framework that you should think about. Because when you're writing an essay, you typically provide a counter argument to you typically provide a counter to your counterpoint, where you don't really need to do this here. You're kind of providing an actual risk that's like an actual risk. So that's kind of on the risk side. I won't go over too much valuation stuff in this video, although it's like definitely something I'd be happy to speak about with any of you guys. Just for the purposes of this pitch, we're not expecting any sort of DCF or model. If you want to take a stab at like providing us with one, feel free, but just know that we will probably ask more questions about that, and any sort of lack of knowledge on like materials that you bring into the pitch is probably going to look worse than, just not bringing it at all. So keep that in mind. If you think you know it inside out, then sure, bring it, test yourself. It'll be a good exercise for you, but we will ask questions on that. That kind of segues well into the conclusion, I guess, which is like, you don't need to have a background of finance knowledge to kind of create this pitch. I was in your guys' shoes freshman year, kind of coming into college, I didn't know a whole lot about this stuff. And it certainly takes time to understand how to analyze businesses. I don't think I'm anywhere close to where I want to be in that perspective. But asking good questions, and like that's the whole point of this organization, right? We're here to kind of teach you guys some of this stuff in the framework of like getting into the workshops, getting into, actual jobs. But for the purposes of this pitch, you don't need like a concrete finance background or knowledge. That's what you're coming into ECMG for. And so the truth for us is that if you're teachable and like willing to work well in a team, that matters probably much more to us. And we'll get a gauge for that in the behavioral interviews, as well as in your application. The stock pitch is more an intellectual exercise for you guys to kind of see, okay, where are you guys at in terms of looking at businesses, and kind of, can you get in the weeds of looking at a business? Is it something that interests you? That was like kind of one thing that freshman year I kind of realized I enjoyed doing this stuff, and that's why I'm making a career out of it. But if it doesn't, then it might not be the right path for you to go down within finance, or finance might not be the right path for you, and that's completely okay. So yeah, I mean, I guess kind of wrapping up, like, have fun with it. It's kind of stressful coming into Kelly, applying to all of these clubs that, it can be very like stress inducing. I know it was for me, but end of the day, the goal here is for you guys to learn and learn with your peers. So bounce ideas off of your peers, make some friends in the process. Again, pick a business that like you have genuine interest in, or at least that you'll be able to understand. And a lot of you guys might pick like aerospace and defense companies, or like SaaS companies, and it's going to be very tough for you to get a good understanding of those companies in the span of like a week. You're not going to get a good understanding of any company in the span of a week, quite honestly. But if it's like consumer facing, like a Target, for example, like what Target does fundamentally, and so it'll be much easier for you to wrap your head around. But again, just have fun with it. Pick a business that you have genuine interest in, understand the fundamentals of how the industry ticks, and really just put together a deliverable that you guys can be proud of. That's kind of all we're asking. So with that, I'll wrap this up. Again, feel free to reach out with any questions to me. Emails njaberi@iu.edu. Happy to answer any questions. Best of luck.